Morning, everyone. Welcome. Thank you all for joining us this early. We're so happy to have you on this Tuesday morning. You could be anywhere, but you decided to be with us. You're coming to learn and gather some information. So we are very appreciative. We're not going to hold you long. We wanted to just share some little nuggets with you just to impart some knowledge and about this home buying process. We have our partner, Mr. Alejandro Rodriguez with Bank of America, who's going to talk about it's great to be a homeowner. And there are certain things that I asked Alejandro to hit on for us, some things that we were seeing in our counseling that was, kind of critical and people wanted to know more about, such as debt to income ratios, the different types of mortgages, and just understanding loan terms. So he's going to hit on some of that information for you all today. So again, thank you all for joining us. And with that being said, I'm going to go ahead and turn it over to Alejandro. Welcome, Alejandro. You're on you're on mute, Alejandro.
I was double muted. Forgive me there. This is
That's
Alejandro
okay.
Rodriguez with Bank of America. My NMLS is 621644. I'm a mortgage lending officer with Bank of America, and I've been with Bank of America since 2004. So it's a little bit over 20 years that I've been a lending officer with Bank of America. We're here, as Aretha mentioned, to talk to you all about a couple of things regarding home ownership. We typically talk about a few basics, but we are going to hyper focus a bit on the debt to income ratio, what comes up and what makes up the debt to income ratios. We're going to talk about a few mortgage basics and the overall loan process. That way we can have a better understanding. What I'm going to do really quickly, are you able to see my screen here, or are you not able to see my screen?
Yes, we can see your screen.
Yeah. It's great to be a homeowner.
Yes, absolutely.
Perfect. All right, folks. So again, thank you all for making time during the week. I know that we're busy. I know that we have things to do, but honestly, investing a little bit in yourself does go a long way. So I appreciate you all making time. Again, we're going to talk about what you need to buy a home. Typically, whenever you go to a lender, in order for us to be able to figure out what options we have when it comes to lending, what programs we have the ability of helping with, we do what's called a mortgage review. And that mortgage review really focuses on two things. And I want to say these two things primarily are going to dictate what options we have as lenders. The first thing that we're going to talk to you all about is credit. So if you're taking notes, number one is credit. Whenever we pull your credit report, we're going to look at your credit scores. We're going to look at your history. We're going to look at how you behave overall with managing your debt. We're also going to have the ability of looking to see if anything that's under your name, you have any credit cards, any car loans. We're looking at those obligations that show up on the credit report, because in combination with your income, it's what ultimately comes up and creates what's called your debt to income ratio. So we're going to deep dive a little bit into credit. The second thing, as I mentioned, is your income. Your income is critical because credit just tells us yes, tells us no, and if it tells us yes, it'll also let us know what programs we have the ability of working with. Once we talk about your income is what tells us how much money we have the ability of lending based upon the individual's income situation. When it comes to credit, it's pretty straightforward, right? Credit is going to give us the ability of knowing what programs we could work with, and if there's anything that you all as individuals need to focus on before we can move forward. So let's understand credit a little bit more. Let's ask the question of what is credit? Credit is borrowing money with the promise to pay it back in the future. How you handle credit is reflected on your credit report and credit score. So what I tell folks, right, when it comes to credit, the best way to look at it is like a book. You are the authors. You as individuals are the authors. You're the ones creating this book of credit. We, as the lenders, we're just opening up the book of behavior. What I tell folks is this. My wife, she's a preschool teacher. She teaches little 3 to 4 year olds, right? And so very basic. On a weekly basis, the way that the parents know how the child is doing is, I think it's pretty straightforward. It's either you get a happy face, you get a good mark, right? Because you did what you were supposed to do, you followed instructions. Basically, you were a good student. If you don't necessarily do what you have to, you're not following instructions, you're not doing what you're supposed to be doing. Typically, what ends up happening is that the child for that week is going to get a sad face, not a happy face. And so, in order for a parent to kind of get a trend, kind of get a hold of how that child is doing, they pick up the weekly report, and it's either going to be happy faces, happy faces, or a couple of sad faces when they didn't behave well. I look at credit the same way. Every single month, anyone you borrowed money from, credit card companies, mortgage company, auto loan companies, to the credit bureaus, they're going to report one time per month how you're behaving. If you make your payments on time, if you're not using more than what you need to on the credit, again, behavior-wise, you're going to get a good mark on the credit report. Likewise, if you're not doing what you need to do, if you're spending more than what the limit is, if you're making your payments not on the day that you're supposed to, you're going to get a sad face, you're going to get a bad mark. And the exact same thing happens. We as creditors, whenever somebody asks us, hey, let me borrow money so I could buy a home, let me borrow money so I could buy a car, we're going to go through and look at the credit reports. We're going to look and see how that individual has behaved, because ultimately that's going to be the reflection that we have on how that individual will likely do on the loans. That's ultimately what credit is, right? So, okay, what is good credit? As we were stating earlier, a history of paying what you owe on time and using credit responsibly, having a high credit score. And typically, the way that you get a good score is by good behavior. Now, the reason that credit is important when buying a home, I'm going to say two things. Number one, as I mentioned before, the majority of the programs that are out there through lenders, they're going to require a minimum credit score and certain credit history. So sometimes, even though you might be able to move forward with the bare minimum of what the lenders are requiring, it might not be under the best circumstances. So you might have the ability of not working with some programs because of the credit, if it's not at a level that it needs to be at, or even sometimes you might pay more interest just because of the fact that the lenders will see it as a riskier product. So it is critical. It is something very important. As I mentioned, one of the primary things that we check whenever we're talking to individuals regarding home ownership. Now, the other thing, I mentioned that credit and income make what's called the debt to income ratio. That's the affordability factor. So what happens is, in addition to us looking at the behavior of the individual when it comes to money that's borrowed, the other thing that credit does for us is that it gives us the ability of looking at all the liabilities, all the debts that are under an individual's name. What's debt? Whenever you look at DTI, debt to income, these are the debts that we're referring to. So we're looking at car notes, we're looking at credit cards, we're looking to see how that individual, any responsibility that individual has under their name. So even if you co-sign for a vehicle for a family member, right, even if somebody else is paying for it, it's going to show up on the credit report, and that's what we're going to look at, because once we talk about income, based upon that individual's income, there's so many expenses an individual could have. That's the reason that credit is critical whenever we're working with mortgages and part of the debt to income ratio. You, as individuals, of course, want to see how you're doing. So you do have the ability of actually going through and ordering credit reports through the three major credit bureaus for free one time per year. So there's TransUnion, there's Experian, and then there's Equifax. If you go to this website, annualcreditreport.com, it's a site set up by all three credit bureaus. You actually have the ability of requesting one credit report from each one of these agencies one time per year. What I recommend folks do is don't get them all at once. Get one, let's say from TransUnion sometime in January, 4 months down the road, sometime in May. Go through and get Experian, another 4 months down the road, October, September, get the one from Equifax. That way, every 4 months, you have an insight look as to how your credit report is looking. That way, you're getting one every 4 months, and you don't have to use them all up in a year, because it will give you one free per year. Credit scores, again, a quick talk about credit scores. It is something that we look at, something that we utilize. Typically, the credit scores, which are going to be reflective of the report itself, range from as little as 300 to 850, depending upon how that individual manages their finances, their payment history, their overall total debt. the length of the credit history, and any new credit that they've gotten, ultimately this is what the makeup of the credit is. Not spending too much time at it on credit as we do other times. Just wanted to talk about it and the importance that it plays whenever we're trying to pre-approve an individual. One, it's going to tell us yes or no, we can move forward. And number two, credit is going to let us know what liabilities, what responsibilities of credit an individual has, because it is critical whenever we talk about debt to income. In just a little bit, I'm going to talk about the second part. We talked about debt. We're going to talk about income. Before doing so, any questions, any comments anybody might have?
All right. I don't see any
All
questions
right.
in the chat.
Perfect. Appreciate that, Aretha. All right, so moving forward, I mentioned earlier that a critical thing that we talk about is debt to income. So we talk about debt. The second thing is income. Income is the purchasing power. Income that we have the ability of verifying from individuals tells us how much money we have the ability of lending. So credit tells me yes or no. Income tells me how much, how big of a loan we have the ability of lending. Now, how does this come into play? Once we have the ability of verifying the income stream of a specific applicant, of a specific individual, depending upon the loan program, typically there's a limit as to how much debt an individual can have. And they do this as a risk perspective. They don't want to overburden or overlend to an individual that at the end of the day might have the risk of not being able to pay this loan back. So it used to be anywhere from around 35 to about 45% of an individual's monthly income that could go to any type of debt. That includes a mortgage payment, that includes any car loan, any credit card that an individual may have. I'm gonna make this up. Let's pretend that an individual has an income of $5,000 per month. 5 per month, so that's about $60,000 per year. But again, we're looking at the monthly income flow. So if an individual has monthly income, let's say of $5,000, and the program says no more than half of your income could go toward any type of debt, what we call the debt to income limit, then that means that out of that $5,000 income that individual has, no more than $2,500, again, 50%, half of that income, can go toward any type of debt. So let's say that an individual comes to me with that same income of $5,000. They don't have any debt whatsoever. That means that their mortgage payment can be as high as $2,500. Again, it's half of that individual's income. So I'm gonna tell that individual, based upon your income, this is your monthly mortgage payment, and the most that it could be $2,500. That's because they don't have any debt. Let's say that that same individual, for whatever reason, has 2 car loans. One car payment is $800 per month, and the other car payment is $700 per month. So they already owe $1,500 on a monthly basis, right? The same thing, their income is $5,000. And we say we can't have no more than half of your income going toward all types of debt. In this particular case, we have 2 individuals with the same income. The first one didn't have any debt up to $2,500. This individual can go up to $2,500 as well, but they already have debt. They have 2 vehicle loans totaling $1,500. So from that $2,500 monthly mortgage payment maximum that they could potentially have, we're gonna reduce it because they already have debt. They already owe $1,500, and there's a limit. That means that their mortgage payment cannot be more than $1,000 per month. Debt to income limit is pretty much limiting me. $1,000 for the mortgage, $1,500 for the car, $2,500 together. So that's why debt to income is critical whenever we're working. Yes, the income is going to tell me how much money we have the ability of lending, but we're looking at the depths as well. And if there's depth in there, it's going to limit the maximum that we have the ability of lending. Does that kind of make sense? Or is there any questions that I might be able to address regarding debt to income? All right, folks, no questions coming through. And again, if you have questions, you can put it in the chat and we'll circle back and address them for you all. Once we identify those 2 things, credit, very straightforward. Request a credit report, we review it. It is what it is, right? When it comes to the income, we'll talk to the individual to verify what type of structure, what type of work they have. We'll talk to the individual to verify the debts that that individual carries. And once we establish the income, right, initially we're just talking, we're having a verbal conversation. But as we proceed, just like anything else, credit report, we're actually requesting the report from the agencies themselves. When it comes to the income, we're going to take what the client, what the individual tells us. But if they are interested in moving forward, we have to back up all of this information. So typically what will happen if we are working with an individual, depending upon the income structure, if the individual works for a company, typically we'll request things like the most recent year-to-date pay stub. We want to make sure that it's year-to-date, that it's reflecting all the income that the individual has earned since the beginning of the year. We're typically going to request W-2s for the last 2 years if the individual is working for a company. Now, if the individual is self-employed, if they own their own company, whether it's a sole proprietor or some type of entity like an LLC or a corporation, typically we'll request signed personal and business tax returns for the last 2 years. Again, if the individual's self-employed, working for their own self, in addition to the tax returns, we'll typically require a year-to-date profit and loss statement. Other things that we typically require as well is bank statements from the individual. But again, any income that's stated that is earned to us, we're going to request documents. If you're retired, for instance, if you receive Social Security retirement, you receive pensions, TRS, any type of retirement income, we do have the ability of utilizing that as well. Typically, we'll request awards letters. With those two things, once we have it in front of us, we'll have the credit report, we'll have the income, we'll be able to find out what the maximum loan amounts that we have for individuals are. We'll have the ability of presenting numbers. Client, this is what we can lend. This is your interest rate. This is your monthly payment. And at that point, if you want to move forward, this is how much cash out of your pocket you will need. If there's any programs, any assistance programs, down payment assistance, closing cost assistance that we have the ability of helping with, typically that initial review will give me the ability of finding that information out as well. So folks, we talked about debt to income. Debt to income is based upon the credit of the individual, specifically their debt. And then we talked about the income part, which is what tells us how much monies we have the ability of lending maximum. Again, typically depending upon the type of program that we're working with, programs nowadays do give us the ability of going up to 50% of an individual's monthly income toward debt. That's basically what our DTI is. In just a little bit, I'm gonna pivot and I'm gonna talk about mortgage basics. I'm gonna talk about the loan process itself, the type of loans that are out there for individuals. Before doing so, and jumping on that area, any questions, any comments, anything that we might be able to address on our part?
No questions in the chat. Do we have any? We must have some experts on here. Alejandro, nobody have any questions? Come on, we need you all to participate.
Good stuff. We're doing a good job, and you all have done a phenomenal job. So they're getting the material. And of course, if for whatever reason we skip over or you don't have enough time to put the question in there, put it in the chat. We'll make sure that we'll circle back for you. All right, so let's go ahead and talk a little bit about the monthly, what makes up a mortgage payment. Once we go and talk to you all about the debt to income, about the maximum loan amount possible, we're going to talk to you all about that monthly payment, right? We're going to say, hey, Mr. and Mrs. Client, this is how much money we have the ability of lending. Based upon this loan amount, this is your monthly payment. Now, again, time to perk up the ears a bit, important information, critical information that you want to be aware of whenever you purchase a home and you're making a monthly payment. Whenever we quote that monthly payment to you all, we're going to include a couple of things. We're going to include what's called the principal, and we're going to include what's called the interest, the taxes, and the insurance. The principal and interest is actually for the monies that we're lending. The principal specifically is the amount that's applied to the outstanding balance of the loan. The interest is the cost of borrowing the money. So depending upon your interest rate in the term, it's going to dictate what your principal and interest is. Typically, whenever individuals purchase a home, almost always, not necessarily always the case, right? But the majority of the time, folks tend to get what's called a fixed interest, where the interest never changes. It stays the same thing pretty much for the life of the loan. Typically, we're working with a very specific time frame, right? Whether it's 15-year note, whether it's a 20-year note, or it's a 30-year note. The interest, the amount that you borrow, and then the term itself is going to tell us what that principal and interest payment is. It's basically the monthly payment. That principal and interest almost always will never change. It'll stay the same thing for the life of the loan until you pay it off, whether you pay it off because you refinance or whether you pay it off because you actually finish paying off the money that you owe. The principal and interest never will change. It's controlled because we have a fixed rate, fixed term, fixed amount of money that we're borrowing. However, we are collecting your taxes and we are collecting your insurance on a month-to-month basis as well. We control the principal and interest. That'll never change. However, the taxes really, they're not dictated by us, by the bank, by the lender. They're dictated by the county, by the city, by the school district that you live in. So for instance, here in the city of Dallas area, the majority of the property taxes, without any well, I should say with discounts, it comes out to be a little under 2% of what the property value is, right? So we have a $200,000 valued property. I would expect those taxes annually to be about $4,000. We have a house that's $300,000. I would expect those taxes to be about $6,000 per year. Again, we don't tell you how much your taxes are. That's done by the tax district, the tax authority. We as the lender, we simply collect whatever those taxes are per year. We divide those by 12 because there's 12 months in the year, and that's how much we collect. This is important. We don't know what that number is. They basically tell us how much we need to collect based upon the estimate, and that's how much we're collecting. The insurance of the home, kind of the same thing. We don't choose the insurance company. We don't offer insurance services, as a matter of fact, here at the bank. You as the individual, you will be responsible for going out there to the market, shopping around for your own insurance company, and whatever it is that they end up charging you on an annual basis, the exact same thing is going to happen. We're going to divide that number by 12. We're going to add it alongside with the principal and interest, alongside with the taxes. And this, folks, it's what makes your monthly payment. Now, here is something that I mentioned that you want to make sure you take a note of. Principal and interest hardly ever changes, right? We don't control taxes. We don't control insurance. We just collect it. They're based upon your property value. What happens typically is that property values go up. So let's say that you bought a house for $300,000 in the very beginning. A few years down the road, even the next year, your property is valued a little bit higher. It's no longer $300,000. It's $305,000, $310,000. What's going to happen? My principal and interest, it doesn't change because everything is fixed. But because your property value went up, the tax authority probably going to say, hey, your taxes are going to go up as well. Your insurance company is going to say, hey, your house is valued at now not $300,000. It's valued at more money. We're still going to protect you, but it's going to cost you more money for us to be able to protect your house. So it can be that your monthly payment on the mortgage that you get, if you include your taxes and the insurance, it can be and very likely will happen that every year it might change a little bit. It might be $5, it might be $10, sometimes even $20 that it changes on an annual basis. But I could guarantee you that it's not because of the lender, principal and interest. It very likely is going to be what we call your escrow account, where we're collecting money for your taxes and for your insurance. So if your bill ever changes, don't get mad. Ask for questions, right? But a lot of folks used to come to me before I learned to coach on it better. Hey, Alejandro, what happened here? You told me I had a fixed rate. You told me my payment would never change. It's now $30 higher than when we started. And then almost always it's going to be because of the taxes and the insurance. Questions, comments that anybody might have? All right, folks, I appreciate that. Moving along smoothly here. Let's talk about a couple of mortgage options that you all will have, right? So whenever you go to your lender, you could do whatever you prefer, right? But sometimes folks say, hey, I want this particular loan because of whatever reason, whatever things that they heard. Sometimes folks don't know what loans are out there. Ultimately, here's what happens, right? The reality is that the individual situation dictates what programs we have. So once we look at the credit information, once we look at the income information, we'll be able to see what programs the individual has the ability of working with. Because sometimes, even though we might want to work with particular programs, it's just simply a choice that we might not have the ability of working with. So the review that we do initially, when we check credit, when we check income, when we check the individual specific situation, we'll be able to know what programs we have the ability of working with. But typically, when it comes to the loan types, you're going to have fixed rate mortgages where the interest rate that we give you is a fixed rate. It never changes, stays the same pretty much for life. Those are the most popular ones. I'll say that over 95% of the loans that we offer probably going to be fixed rate. We also, and the majority of the lenders out there also offer adjustable rate mortgages. These are mortgage loans that adjust. The interest rate could go up, the interest rate could go down, depending upon however the market is doing. Some of these folks like a hybrid in which for 5, 7, or sometimes even 10 years, we'll give the individual a fixed interest rate, and then after the fact, it becomes adjustable. The reason that folks sometimes go through and get adjustable rates instead of the mortgage rate is because, one, this right here, the fixed rate typically is a 30-year program, sometimes 15, and an individual is really not planning on paying it off sooner, and they want to have a little bit of protection in case there's changes in the market. An adjustable rate mortgage, it's an interesting program that folks might be able to use if they're really planning on not staying in the house forever, if they know they're going to be in the house 3, 4, 5, a couple of years and then potentially sell it, or if they know that the interest rates are in an environment that they're elevated and they know they're probably going to drop in the near future, they go for adjustable rate mortgages. Typically, adjustable rate mortgages might have an interest rate that's a little bit lesser than the fixed rate, but again, it is adjustable, so it can change. Whether it's up or down, they can change after a certain amount of period. But those are the two options that we typically have. When it comes to the product specifically, here, there's different types of loans, right? Through Bank of America, for instance, we offer the conventional loan, we offer our FHA loan, and then we offer VA loans as well. Outside of Bank of America, there's other programs like, for instance, USDA loans, which are the same thing, mortgage loans that individuals typically utilize whenever they're purchasing in rural communities. It is unfortunately not a product that we have here at the bank. Conventional loan typically is the type of loans that individuals like to utilize, the ones that I'll say has the least amount of fees typically. FHA is a great program, works very similar to the conventional loan. The only difference is that we have the government backing up these types of loans. And because the government is involved, it makes it a little bit easier for folks to qualify. Doesn't necessarily make it less expensive. It makes it easier for an individual to qualify because the government is involved. And then VA loans, you have to be a veteran, and not only a veteran, you have to be an approved veteran for you to be able to use the VA loan. VA loan, an excellent program. It gives the ability of folks to move into a home with zero down payment, no mortgage insurance. But again, you do have to be an eligible veteran in order for you to be able to take advantage of the VA loan. Any questions, any comments anybody has? I'm able to hear you, Mr. Rita. No questions?
No questions. Like I say, you've done an awesome job.
Perfect.
Yeah.
How are we looking on time? Are we
We're
still
good.
on
We're
time?
right there. Yes, we're right there at 10:30.
Okay.
Yes,
Do we continue going a few minutes, or do we open up for Q&A, or what should we do?
we can open it up a few minutes for Q&A. I just want to be mindful of everybody's time and appreciate them joining us. Do you all have any questions that you want to ask or pitch to Alejandro before he leaves today? Please drop them in the chat. Thank you, Elaine. I'm hearing good info, Alejandro, coming through the chat. Again, I know that they are very appreciative. They always are when you come and you break down the information, and make it so easy for us. So we appreciate you.
Absolutely, folks. All right, folks, closing out, in just a couple of minutes, I'll say about 2 or 3 minutes, want to highlight some things for you all really quickly. Just things to expect, right? Typically, whenever you work with the lender, all of those the conversations that we had, you go through the numbers, we talked to you about what we could offer. At some point, when we get to those numbers, you're going to say, hey, I do want to move forward, and you'll work with your bank on either the pre-qualification or the pre-approval. Ultimately, the pre-qualification and the pre-approval is not the final step. It is not a commitment. It's just for you and for the bank to come to an agreement and for the bank to tell you as an individual, hey, we're going to lend this money to you. That way you can start looking for the home. You're going to get a pre-qualification, pre-approval. Once you find your home, the property that you're purchasing, whether you're working with a real estate agent or not, once you get that contract to us, we'll do an application for you. We'll send it over to underwriting. We'll do our due diligence, check on the property, check on the individual, make sure that all the ducks are in a row. Everything is good to go. We'll give you what's called a final approval, where the bank says, hey, good to go, property is good, loan is good, money is good, let's sign the documents. And that's ultimately what closing is. You sign at the title company, do your due diligence, make sure that everything is correct, make sure the numbers don't change, which they shouldn't, but make sure that's the case. Review everything prior to closing, and ultimately you show up at closing with the title company, sign documents for about a half an hour, no more than 45 minutes typically. Once you're done, once both parties sign, sellers and buyers, will do what's called the loan funding. That's when the keys drop in the hand and you're a happy homeowner. Folks, that's what I have. A lot of information in the mortgage world, certainly that we could share. Here's my contact information. Again, name's Alejandro Rodriguez. I'm with Bank of America. If there's ever any questions, just general conversation that you want to have, no commitment, feel free to reach out to me. Anything that I might be able to provide guidance on and helping with, that's what we're here for. Folks, any questions, any other thing I might be able to address for y'all before we leave for the day?
Again, great information, Alejandro. Always a pleasure to have you to come and share your wealth of knowledge with the community. Thank you so much.
Absolutely.
And I want to let our participants know that our next webinar is at 2:00 p.m. today. Feel free to join us. We have Miss Alexis Horn with Prairie View A&M Extension, who's going to come and she's going to speak on emergency and disaster preparedness. And, you know, with everything with the climate change and just so much happening in Texas with the weather, please be, come and join us for about 30 and 40 minutes to get some information on how you can be prepared for this extreme weather that we're having. Thank you. That's at 2:00 p.m. Thank you so much. And thank you again, Alejandro. Everybody have a great rest of the day.
Absolutely.
Thank you.
Thank you all.
Bye-bye.
Bye-bye.